All right, traders, now we move to the most important part of our trading, market structure. In this lesson, talking about trends, ranges, and key levels on the higher time frame and the lower time frame. All right, so we can see on my screen, there are candlesticks and we can see that one is going down. Sometimes the market is not super clear and clean when it wants to go down and up. So in the last couple videos you've seen, I've marked out structure, but now we're going to identify what even market structure is, okay? So first things first, we're going to mark off where price stopped. And as we can see, there is a high right here. After there is a high, there's got to be a low somewhere. The next low presented is right here. After each low, there's a high presented, and the next one is right here. The one after it is a little bit underneath it, so that's okay. Where is the next major low where price stopped before going higher? Right here. Okay, we're going to mark this out. The most recent high. After that low, right here. Okay, and so now what I want you to identify, after I put some of these markers back on here, we're going to identify what you know as the higher highs, the lower lows, the lower highs, and the lower lows, which can seem confusing at first, but once you see it, you can't unsee it. So let's go ahead. I'm going to mark out the rest of these highs and lows, then we'll kind of get to the higher highs, lower lows. Alrighty, guys, we have it. It's finally on the screen, and we are going to draw this out with our path tool yet again to kind of see it a little clearer. Wonderful. Now that we have our pathway on the charts, let's go ahead and remove the candlesticks. All right, and as we can see, again, clear as day, price is moving down. So there are these things that can help you identify the trend known as higher highs and lower lows and lower highs and lower lows. We're going to type this out to show you which one creates which market. When price has a high and then moves down to make a low and then moves down to make a lower high than the previous high, that is considered a lower high. Once price moves down and makes a lower low than the previous low, that is a lower low. We're going to do that one more time. A lower high than this previous one, a lower low than this previous one. And as you guys can see, the market is moving exactly like this, straight down. We're going to type this out so you guys can see that we have a high, just a normal high right here. Let's go ahead and remove that border so it's not too crazy. And the wrap. Okay. So we have a high right here. And is this high higher or lower than the previous one? It's lower, so we're going to write a lower high. Perfect. And what is the next low? Is the next low lower or higher than that one? It's lower, so we're going to write a lower high. Beautiful. So then if my highs are lower, wouldn't my lows be lower too? Absolutely. Let's write that out. We have a low. And then the next low after it is a little bit lower than it. So we're going to write a lower low. And then we have this final low down here, and that's a little bit lower than there as well, the previous one. So we're going to write a lower low. So when price is making lower highs and lower lows, we have a bearish trend. All right, and again, that looks like this. Lower high and lower low. Now that we've identified bearish market structure, we're going to find a bullish example as well. I want you to go back, pause the video right here, and go back on your charts and see if you can identify where there was a high, and after that high, where was the next low, and after that low, where was the next high. See if you can identify a bearish trend in your market. This is what that would look like when we have put the candlesticks back on the charts. We're going to remove the line. We can see that price made a high, a lower 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 high, finally a higher high. Then we have a lower low, another lower low, another lower low, another lower low, another lower low. When we have lower highs and lower lows, we are in a bearish trend in the market. Now we are going to look for a bullish trend. All right, I think I see one. Do you see it too? Let's mark it out together. We have a low, then we have a high, then we have a low that's higher than this low, then we have another high, then we have another low, and another high. This high got broken. It made a teeny tiny little low right there. If you don't want to count that one, you can always count this low and move this high to this very tippy top. Okay. Perfect. So let's get back. Let's go get our path tool and draw this one out now. We have a low, a high, low, high, low, high, low. All right, let's go ahead and remove those candlesticks to see this pattern. We can see that price has made a low, a high. This high is higher than that low. This high is higher than that high. This low is higher than that low. This high is higher than that high. This low is higher than this low. So when we're dealing with a bullish market, we want to see higher highs and higher lows. Okay, what does that look like in terms of the letters? That just looks like a low, a high. Why is it wrapped? I don't know. We're going to take that off. All right, and then once we come to the next low, this low is higher than the other high. So we have a higher low right here, and we have another low that's higher than the previous one. So we have another higher low. We have another low that's higher than the previous one. So it's another higher low. And then of course, guys, this high is higher than that one. So we have a higher high. This high was higher than that one. So we have a higher high. Okay. Higher highs and higher lows for a bullish market. So that means I still want to see this happening on my charts, and we can clearly see that price is moving in an upwards direction. Beautiful. Now we understand higher highs and higher lows, lower lows and lower highs. Let's now get into ranges. So once price makes another high or another low, okay, we will take the low and the high as our range. So this is a range right here. Boom and boom. Everything in between these orange lines is a range. So once price breaks that structure, and make a higher high, this now becomes the range, that high to this low. So as price is moving, and we can see price is moving higher, we like to consider this a pullback. Price was inside of this range, pulled back into the range, and then broke above the range. It kind of retested and came back to the range, but it was slightly above. But within its own range, it is now within those two orange boxes before then pushing up higher. The same goes for a bearish trend. Price is moving down. We have a high and a low. And those are our ranges. Price is here and here. It came back into the range and then tried to break out of the range. Okay, this is super important for the strategy that we are going to learn in this course, which is supply and demand. We're going to learn the basics because, guys, the market moves in 3 different directions. It moves up, it moves down, and it moves sideways within the range. So just like we previously demonstrated, price is here at this high and also here at this low, and anything in between this orange, in between the orange lines are ranges. So what do I do if price is moving within a range? This is considered consolidation. Price has no idea if it wants to buy or if it wants to sell. There are bulls in the market, there are bears in the market, and they're a little bit even, okay? Price isn't really giving us a direction of where it wants to go. For the strategy of supply and demand, we only take it in bullish markets or bearish markets. If the market is moving sideways, we don't really want to be taking a trade. There is a strategy for that. A snippet of that is considered support and resistance, but that is just more of a key level for me as a supply and demand trader. So let's get rid of these and look a little bit more into this. When we think about support, we can think about something holding something up, right? So this bottom line would be our support. Now let's say we are holding up right here and we have that support, but then we run into that higher orange line. That would be considered our resistance. Price is resisting going higher. All right, so now price has hit the resistance. It's not allowed to be pushed higher. It comes back down. It hits the support. It's not allowed to drop a little bit lower, and it's just staying in this range. This is an easy way to identify if price is in consolidation or not. Let's see if we can find an example on the charts. Perfect, right off in here. Let me know if you can see it before I see it. All right, so price came up to this level quite a few times, at least 2 times, and then it came down here around this level. It hit the support level a few times, and price was held up. And then it came up, and although it was a resistance level here, the market was strong enough, the bulls were strong enough to break out of that resistance. Of course, soon after it, price came right back down into the range and then began to move a little bit lower. So this just faked people out. This is why I don't trade consolidation, because we don't really know what the market really wants to do. We want to see breaks of structure to the downside. The last thing I want to talk about in this video of the course is key levels. Your key levels will be found on your higher time frames. If you remember from the last video, we'll go up here to the top, and our higher time frames can be anywhere from the daily time frame and higher, or the 4-hour and the 1-hour time frame. So let's just go to the 4-hour time frame. And right here, we're going to kind of mark out that support and resistance level. But we're going to see where price had a really harsh stop and a really harsh bottom. All right. So as we can see, price came right here and just completely stopped moving. We can see that from here, price moves super high into the sky and then came way up here and stopped. It hit this area around 2 to 3 times. Can you guys see what price is doing in between this range? At this key level, it came down to, price shot all the way up. And now that we're back at this level, we've now broken below it. Okay, so we want to keep that in mind for when we're trading. Look, the overall market looks like it's moving in a downtrend. I love it. All right, so this is just the 4-hour. Let's see if we can find a 1-hour key level. All right, I can see one bright as day. If we look right here, boom, we have a level right and in our face waiting right there, price came down and just completely obliterated it. When we see prices come to a level more than one time, that can be considered your key level. Now that we've learned what support and resistance looks like, higher highs and lower lows and lower lows and lower highs, now that we've been able to identify an uptrend, a downtrend, consolidation, and key levels, I want you to take some time to practice marking this out on your charts.